Again, welcome back, dear viewers, and today I'm about to reveal something that could completely change the way you think about wealth. Imagine holding in your hands a single asset that has the potential to multiply your financial security, protect you from uncertainty, and put you ahead of the crowd. Yet almost everyone is completely overlooking it. Most people will scroll past thinking it's just silver, just another shiny metal. But that what I'm about to share with you could make owning just 1 kilo of silver the smartest move you make into, because here's the truth. The world is changing, money is shifting, and governments are quietly setting the stage for a future where only those who prepare today will thrive tomorrow. This isn't speculation. This isn't hype. This is about understanding the forces that are about to push silver's value higher than most people can even imagine, and why if you don't act, you could wake up one day wishing you had. Stay with me, because by the end of this video, you'll know exactly why owning just 1 kilo of silver is not optional. It's essential. The clock is ticking and the opportunity is real. Listen, when I talk about silver's structural supply deficit, I'm not just pointing to a short-term blip or a commodity cycle. This is a deep systemic imbalance, one that's been building for years, and it's exactly the kind of dynamic that wise investors spot early, then lean into. Let me break it down for you bluntly. Every year, silver demand continues to outpace supply. In 2024, the world consumed more silver than was produced by a large margin. According to the Silver Institute's World Survey, that deficit was 489 million ounces. That's not a fluke. That's the fourth straight year of a structural shortfall. Over the last 4 years, combined 2021-2024, the cumulative deficit reached 6,700 announced to nearly 10 months of global mine supply in 2014 alone. Why is this happening? Because silver supply is being squeezed from multiple angles, while demand is surging in some of the most powerful industries on the planet. First, on the production side, things are tight. New silver mines aren't being built fast enough. Exploration investment in primary silver projects are weak. Many of the big silver mines have declining or grades, meaning each ton of rock produces less silver than before. At the same time, much of silver production comes as a byproduct of mining for other metals. Copper, lead, zinc, the Silver Institute that makes silver supply less responsive to its own price. Even if silver becomes more valuable, you can't just snap your fingers and produce more because production is tied to other mining economics. Second, recycling, which you might think would be a huge relief, isn't scaling fast enough. A portion of silver comes back through recycling old electronics or jewelry, but this is becoming less effective. Many industrial uses of silver are dissipative. Once the silver is used in tiny electrical circuits, it's very hard or uneconomical to recover physical gold. On the demand side, the pressure is relentless. Industrial demand for silver is hitting record highs. In 2024, industrial usage reached 61.5 million ounces, fueled by growth in green tech, solar panels, electric vehicles, grid infrastructure, and even arid electronics. These are not niche markets. They're foundational to how our world is evolving. The energy transition, digital transformation, and electrification are not slowing down. They are accelerating. Silver is right in the heart of that revolution. What this means is simple. The supply side is kept constrained and underfunded, while demand is growing structurally and aggressively. That gap doesn't just go away, it compounds. Inventories above ground are being drawn down, and new supply is struggling to keep up for someone building real wealth. This is not noise. This is a signal that silver is becoming more than a precious metal. It's a strategic industrial asset that is being consumed faster than it can be replaced. That's the very definition of a structural deficit. And in markets where supply can't catch demand, the wise don't just watch, they act. When you understand this imbalance, you realize owning physical silver today isn't a speculative bet, it's a hedge. It's a way to lock in access to something increasingly rare, yet more essential for someone serious about financial freedom. That's a powerful position to be in. You need to understand something very powerful. Silver is not just a precious metal anymore. It's becoming one of the foundational building blocks of the 21st century industrial revolution. The industrial demand for silver is surging, and it's being driven by some of the biggest structural trends of our age: green energy electrification, high-tech electronics, and data-driven infrastructure. When you see that picture clearly, you realize this isn't a speculative fad. It's real deep and potentially explosive. Industrial demand for silver recently hit a new all-time high. According to the World Silver Survey, it rose to 68 ounces in 2024, driven by electronics, photovoltaics, automotive, and grid investments, the Silver Institute. What's striking is that the strongest uplift came from the green economy: solar panels, EV-related infrastructure, Data centers, AI hardware, all of it start with solar. Every solar PV cell needs silver paste to conduct electricity. And that silver is not trivial. It's one of the most critical components. As global solar capacity expands aggressively, demand from solar is rising steeply. Some forecasts warn that by 2030, a very significant chunk, nearly 30% of silver supply could be going into PV Baker steel capital. This is not just use more silver, but use silver more intensively in newer high-efficiency solar cells. Then there's the electric vehicle revolution. Modern EV use far more silver than legacy combustion engine cars. Silver is in connector switches, sensors, and power electronics. The UPS times plus to invest AEV adoption accelerates that. Silver demand compounds. Add to this the need for charging, infrastructure, grid upgrades in the entire green energy ecosystem, and you've got a silver use case that's not going away. It's scaling. But it doesn't stop there. The electronic sector is another voracious consumer. Silver's unparalleled electrical conductivity makes it ideal for semiconductors, printed circuit boards, EOT devices, 5G infrastructure, and more. As data centers, artificial intelligence, and high-performance computing grow, they need materials that can handle massive power and thermal loads. Silver is a go-to. They invest. In fact, even AI advances are playing a role. The growth of data centers and more complex electronics is pushing silver demand higher. Grid infrastructure itself is shifting as nations invest in green grids and distributed energy. Silver is needed for electrical components, contacts, and transmission systems. That demand may sometimes be overlooked in traditional commodity narratives, but it's very real and very structural. Look, when you combine all these forces, solar, electronics, grid, you're not dealing with a momentary spike. You're looking at a transformation. This is structural demand, not a blip. For someone thinking long-term wealth, that's very, very meaningful because when industrial demand is this strong and growing, physical silver becomes more than just a hedge. It becomes a strategic asset. If you hold silver in this environment, you're not just betting on price, you're owning a piece of innovation, a stake in the future. And as industrial demand continues to tighten the market, that silver you own today could be more valuable tomorrow. Not because of hype, but because industry itself is demanding it. When I talk about silver right now, I'm not just talking about a shiny relic. I'm talking about a powerful lever in a changing macro world. And one of the biggest levers is monetary policy. The winds are shifting. Central banks, especially in the US, are expected to cut interest rates, and real yields are likely to fall. That creates one of the most favorable environments for silver as a non-yielding asset. Here's how it works. When real interest rates are high, holding something that doesn't pay you anything, like silver, feels costly. You could just put your money into bonds or cash and earn a yield. But when real yields fall or even go negative, that opportunity cost collapses. Suddenly, silver looks a lot more attractive. Investors don't give up income by holding it. Instead, they gain potential. Upside without losing yield. That's exactly what many analysts are expecting. Forecasts suggest that rate cuts may begin or accelerate in a dovish pivot by central banks that could drive real interest rates lower. Real yields are turning less punitive for precious metals, especially silver, whose appeal grows when the cost of holding it is lower. At the same time, there's geopolitical uncertainty and currency risk. A weakening US dollar often goes hand in hand with rate cuts, and that works in favor of silver. As the dollar softens, silver becomes cheaper for global buyers and more attractive as an alternative store of value. When macro risks mount, investors often look for hard, tangible assets, and silver checks that box. But there's more. Rate cuts don't just lower the opportunity cost of holding silver. They can also spark portfolio flows. With real yields dropping, institutional money and ETF investors are more likely to allocate to none. Yielding assets are already seeing strong inflows driven in part by this macro shift. EC Financial Group, those inflows aren't trivial. They reflect serious capital repositioning, not just speculative bets. This isn't a short-term trade. The dovish turn in macro tailwinds make silver a strategic asset. When policymakers ease, liquidity tends to fold into real assets. Silver, with its dual industrial investment demand, benefits from both sides of the equation. Another piece of the puzzle, negative or low real yields, makes silver more compelling as an inflation hedge. If rates are cut but inflation remains sticky, real returns on bonds or cash can turn negative. That's a danger for savers, but it's an opportunity for those holding precious metals. Silver, unlike a bond, doesn't promise income. Instead, it offers protection and optionality. In short, the macro environment is aligning in silver's favor. Rate cuts, falling real yields, and a weakening dollar are not just tailwinds. They are rising when pushing silver higher for someone who thinks long-term this isn't noise. This is a structurally supportive backdrop. By holding silver, you're not just sitting on a commodity. You're riding a macro wave that could reward real asset investors in a big way. Right now, something very powerful is unfolding in the silver market. Institutional and retail investors are pouring money into silver-backed ETF like never before. And that's not just a flow of capital, it's a lockup of physical silver into vaults. When you understand how this works, you see why silver isn't just being bought. It's being hoarded in a way that tightens the physical market and strengthens its long-term case. In the first half of 2025 alone, silver EDP exchange-rated products attracted around 95 million ounces of net inflows. That's more silver going into ETF in 6 months than in all of last year. By the middle of 2025, global ETF holdings reached 113 billion ounces, pushing the total value of these holdings past 40 billion for the first time. This isn't small change. This is a serious movement of capital into real physical silver via financial structures. Why does this matter? Because when ETF accumulate physical silver, that metal is often earmarked for long-term storage in vaults. It's not going back into the industrial market or being recycled quickly. It becomes effectively off the table for other uses. In some analysis, ETF vaults are now holding more silver than even the registered London vault. ETF stream that creates a kind of artificial scarcity. The industrial consumers and other buyers need silver, but so much is being locked into investment structures. This dynamic is reinforcing itself as inflows surge. ETF issuers need to secure more physical silver to back new units, but supply is already tight. When creation demand intensifies, it strains the system. Some silver ETF are even facing liquidity pressures. A few fund houses have temporarily halted fresh investments into their silver ETF funds because they can't create new union. It's fast enough against the backdrop of surging demand and limited physical silver. Business today caught one. That's how tight things are getting, not just on paper, but in real metal. There's also a powerful feedback loop. As ETF continue to build their silver holdings, it supports the price. That rising price attracts even more, and flows both from retail investors who see silver as a long-term real asset, and from institutional players who view silvers as a way to gain exposure to both investment demand and industrial strength. Analysts at major banks and institutions are watching this closely. ETF. Another important point, this inflow is not just marginal. Some reports suggest that the level of silver now locked into ETF could represent a significant share of annual silver consumption. Discovery alert in effect. New investment is consuming silver that might otherwise go to industrial uses, tightening the physical market further. For someone building serious wealth, this isn't just a trade, it's a strategic play. When you own physical silver or invest via the right vehicle, you're aligning yourself with a trend where capital is not just flowing in, it's sequestering the asset. That's how real scarcity builds. And in a market tightening at the supply level, that locked-up metal becomes even more valuable. So when I talk about owning silver, even just a kilo, I don't say it lightly. You're not just buying a commodity. You're owning part of a real physical asset that is being claimed aggressively by global capital. And that claim is not temporary, it's structural. Let's talk about value. Real, tangible, measurable value. One of the clearest ways to see it in the precious metals market is the gold to silver ratio. Historically, this ratio has averaged around 55 to 60 ounces of silver for every ounce of gold. When the ratio rises dramatically above, that signals one thing loud and clear. Silver is undervalued relative to gold. And right now, that ratio is in the stratosphere, well above 80, which tells anyone paying attention that silver could be one of the most mispriced assets in the financial world. Why does this matter? Because gold and silver have always been Canada's stores of value. They are both tangible assets that preserve wealth through cycles of inflation, monetary turmoil, and financial uncertainty. But unlike gold, silver is also industry. That dual-role investment in industrial utility means its price can swing more dramatically, creating opportunities. When silver is cheap relative to gold, it's like getting a high-quality real asset at a discount. It's rare, and opportunities like this don't linger. Investors who understand this are watching closely. They know that when the gold to silver ratio is high, silver historically outperforms gold over the following years. For example, in the late 1990s and early 2000s, the ratio surged above 80, and those who allocated capital to silver experienced remarkable gains as the ratio normalized. These cycles repeat because the market has memory. It corrects mispricing over time. Right now, with silver trading at historical lows relative to gold, that correction could be imminent. But here's the kicker. The ratio doesn't just reflect price history, it reflects fundamentals. Silver is increasingly scarce relative to industrial demand. Mines are producing less silver. EDF are locking it away, and industrial growth continues to absorb significant quantities every year. Meanwhile, gold production is relatively stable, and much of it is already held in central bank reserves or investment portfolios. The imbalance between these two metals makes silver not only undervalued, but structurally positioned for a potential rear rating. This is where strategic thinking comes into play. Smart investors don't just look at current prices in isolation. They compare assets to one another. They recognize that when silver is cheap relative to gold, the upside potential is enormous. If the ratio returns to historical norms, even partially, silver could outperform gold by multiples, generating wealth for those who acted early. It's simple arithmetic backed by market history, but very few people actually act on it. And don't forget the psychological element. When markets focus too much on gold and overlook silver, the crowd is often laid to notice that creates a window of opportunity for those who see the undervaluation clearly. Buying silver now when it is discounted relative to gold is not speculation. It's a calculated move based on historical patterns, fundamental scarcity, and industrial demand. In essence, the gold to silver ratio is like a flashing warning light and a guide post at the same time. It tells you that silver is cheap, that a correction is likely, and that owning it today can be far more profitable than waiting. For anyone serious about wealth preservation and growth, ignoring the signal is a mistake. Owning physical silver or silver-backed instruments now isn't just a hedge. It's a strategic play to capture value that the market has temporarily mispriced. Timing matters, fundamentals matter, and relative value matters. Silver is positioned to benefit from all three, so why do you need to own just 1 kilo of silver? Because it's a hedge against uncertainty. Because it's a stake in the green tech revolution. Because supply is tight and demand is real. Because institutional money is locking it away, and because right now silver may be one of the most undervalued real assets you can hold in the journey of financial freedom. Owning that kilo is not just metal, it's optionality, it's security. It's a silent partner working for you long after today's headlines fade. You don't need 10 kilos. You don't need to time the top. You just need 1 kilo.